Hi, this is Yoder. Thanks for listening. I wanted to show you some of the recent market action in the S&P 500. Normally when I trade the S&P, I'm looking at the ES chart, and that's what you're looking at here. This is the ESM contract, which is our current contract for the mini contract on the S&Ps. As you can see from the volume here, this is one of the flaws of looking at longer-term futures contracts. They only trade over a certain number of months, very much like an option, and they expire at the end of that time. There's a lot of argumentation amongst some of the folks that I trade with about whether a continuous contract is accurate enough to really trade off of or not. So what I tend to do is default back to the SPY when looking at anything more than, say, a couple of weeks in the daily time frame. So let's go ahead and do that. And you can see here if I switch back to the SPY, that S&P 500 index proxy, that of course we have continuous data going back to the beginning of the year. So let's just recap. Obviously, we have the market, which has collapsed as a result of the whole subprime mess. All the bailouts and things have then come in. We've seen the market pop. It popped very consistently in what you might expect, right back to areas of chart resistance. And if I bring up my trend tool here and draw a horizontal line at the very low of that range and sort of in the middle of that range, you can see how that resistance level has been important for several of these little minor tops in the overall market. Now, as any of you who've read my articles or seen some of my other videos posted on my blog, you'll know that I've been bearish for some time. I think that the market is replaying the same bottoming action that we saw in the 2001-2002 bottom, which occurred, of course, after the tech bubble burst. In that market, we had a very strong capitulatory bottom, very much the same as we see here. We had a bounce of about 20%, which is pretty much what we've seen here. We came up to areas of chart resistance and moving average resistance. And actually, if I just take a moment and flip this daily over to a weekly chart, here you can see the moving average resistance. This green line is the 20-period exponential moving average. And you can see how even though it pushed through during this time frame here and tested here, that the 20 has been the dominant resistance level for really the entire bear market over the last couple of years. So it's a very important level. So again, dropping back to the daily chart, we can see that there have been a number of little false starts. Obviously, again, getting on our tool here, first time we hit resistance, there was a very nice sell-off. I had that sell-off right from the very highs, too. It was a wonderful position. Gave me 2 solid days of profitability, and then gapped up the next day, took about half my profits away, and ended up squeezing pretty heartily. So that was definitely a failed trade, but one that provided a little bit of profit. Then we had the next opportunity as the market pushed up further into the mean of the range, the middle part, and once again had that trade. I think it was during this day here, and then had a beautiful gap down. The next day the market rallied, came up to this former resistance level, as you can see from the very top of that tail, and that resistance was enough to push it back down to its lows. It gapped down the next morning. I thought it was golden and was expecting to see a strong move back down for that retest, as I had been talking about. And instead, again, another squeeze. So here are 2 just wonderful entries which could have delivered massive risk-to-reward ratios. Both were very tight intraday type entries into what should have been a multi-day, if not a multi-week hold. Both got squeezed out. This one for I think this one was a small profit. This one was a loss. And then we went through the cycle yet again. Let me go ahead and clear this out of there. The next resistance level, right in the middle of that range, you can see right in the middle. Again, we had good signs of resistance. We have 3 days here, essentially, with a wall around the 85 or actually $84 per share area. And then the market came back down. Again, moving back down towards moving average support. Ended up with a good solid red bar. Again, I went to bed that night feeling very happy about my position. And once again, the market came up, stopped me out on a gap, and went along its merry way. So I've been talking about this frustration that I've been seeing, but yet I'm sticking to my plan, and that's really what I want you to take away from this video. Even though I'm essentially stepping up to the plate, doing everything I can do correctly and effectively to get great entries right in the top of this bar, right in the middle of this bar, and somewhere in the middle of this little range here, right near the ties of these moves. Really all I can ask of myself is to get the best entry possible, even looking back in retrospect. But once that entry has been taken, the trade's out of my hands, and I just have to wait for the market to either follow through or stop me out. But persistence is really important, and this is the reason why. I tend to trade a very high risk-reward type model, which means that my accuracy rate is low. I don't win all that often, but when I do, it's very, very large, and those gains more than make up for any of my losses. And I find this to be a much more profitable way to trade than a higher accuracy rate with a lower risk-to-reward ratio, which is more of a grind. Yes, you'll be profitable more often than not with that style. You'll have bigger drawdowns with the style that I employ, but as a grinder, it's a lot more work, and you really don't have as much profit potential when the market really begins to move. And here's the reason why. Had I taken this trade down to my original profit target, I would have gotten a pretty decent risk-to-reward ratio, but it probably would have been about, I'd say, 4 or 5 to 1. This next top that I shorted probably expanded that risk-to-reward ratio a little bit more, maybe 5 or 6 to 1. But now look, I've got the same trade. I still think that the market's going to go back down and at least retest the 72 to 74 level and make a higher low, or go right back down to 68 or 70 and retest the lows, which I think is probably more likely at this point. I think the market is weak enough that it really needs a double bottom if it ever is going to put in a serious bottom. And obviously, if current weakness continues in terms of some of the economic numbers that are coming out, and I really believe that the bank stress test data is going to be a fairly catastrophic bit of news when that hits, and I think that's going to accelerate my short positions. So there's some more fuel to that fire. But in any case, even if it only goes to my most conservative target, right around $74 per share, I'm still going to get radically increased risk-to-reward ratios near probably 8 or 9 to 1. If it goes back to the lows, it'll be in excess of 10 to 1, which more than makes up for the scratchy trade here, the loss here, and the loss there. So pretty minor series of so-called pies in the face before hopefully the last entry, if this indeed turns out to be it, that delivers the good solid risk to reward. So now the question is, when you've had negative feedback from the market, when you've gone into that market and essentially gotten slapped, why keep going back? Well, because my research is much deeper than just 1 or 2 patterns. I know that if I seek out these important trend change moves, utilizing my day trading skills to take very elegant entries on the intraday markets, and then essentially taking that scalp and just letting it ride, holding it for a swing, if not a position trade, I can reap enormous risk-to-reward ratios off those intraday entries. But it very rarely happens on the first try, and sometimes it takes 3 or 4 tries before you get the trade that ends up becoming the big trender, which makes your month, your quarter, or sometimes your year. I've had a couple of these that went 22 to 1, and literally what was the bulk of my profits over the course of a year. And this kind of trading is very much follows the 80-20 rule, which is so true in many parts of life. 20% of your profits or 20% of your gains will produce 80% of your profits. So it takes a certain kind of psychology and a certain mindset to be able to go ahead and go into a trade knowing that the likelihood is that you'll end up taking the stop loss or a scratch. Essentially knowing that you're fishing for that big home run gain, which will eventually show. The key is, will you be there when it does? And will you have the guts to hang on and hold that trade to maturity? And those are things that I work with my clients a lot about, sticking to their guns, sticking to their plan, and really reaping the rewards of that campaign-style trading strategy. So there's a little bit of pretty current information. Obviously, we're looking at the chart today as the market gaps down. A little too early to get very excited again. We're very much in the same situation we were on this day and this day when the market's beginning to challenge some minor support levels. But, however, I got yet another clear top. And if this time is the magic time where the support fails, I'll have a really great trade which should stay open for several weeks. So there you have it. As always, thanks for listening. My name's Yoder. Good luck and good trading.